Good morning and welcome to the financial news. In January 2014, Google bought Nest Labs for $3.2 billion, causing a 1,900% increase in share price. Now, in investors' rush to profit off this decision, investors bought stocks in Nest Inc. and not Nest Lab. This is a perfect demonstration of how people can act irrationally and emotionally on the stock market and is the basis of behavioral economics and finance. To learn more, we're going to go to our expert in New York, Eileen.
Hello everyone. Behavioral economics is the counterpart to classical economics in that they take the human aspect into account. This means that they assess how economic decisions are influenced by psychological, cultural, social, and emotional factors. Let's look at the main assumptions of both models. In the classical economics model, people always act in a rational manner, and thus always make the optimal choice due to perfect information. In contrary, in the behavioral economics model, people base their decisions on subjective factors and rarely make the optimal choice. Thus, the main characteristic of behavioral economics is the dimension of human unpredictability.
Interesting. So basically, behavioral economics and finance tries to explain why people make irrational and emotional decisions in certain situations.
Not quite. Behavioral finance is a subfield of behavioral economics and cannot be used as a synonym. Behavioral finance focuses mainly on explaining how human financial decisions are influenced by stock market anomalies, whereas behavioral economics comprise more theories. It focuses mainly on the hidden influences that have an impact on our financial decision-making, loss aversion, the availability bias, and the nudge theory.
Fascinating, but this doesn't relate to an everyday consumer.
Wrong. Consumers are exposed to this every day, for example, through advertisements. Marketing companies make use of behavioral economics by customizing different services or basing their ads on certain psychological concepts. For example, would you rather buy a yogurt that contains 25% of fat or is 75% fat-free? Well, according to the classical model, you should not be influenced by the label, since it's the same product. However, you react differently to the same type of information just because it's presented in a different way.
Thank you, Eileen. I never expected behavioral economics to be so prevalent in our daily lives. In order to delve into the key concepts of this, first we're going to talk about home bias. Let's go to our expert, Leah.
Have you ever heard the advice to invest in what you're familiar with? If you followed it, you may have suffered from home bias. Home bias is the tendency for investors to invest the majority of their stock in domestic equities rather than benefiting from diversification. This isn't always optimal. Imagine if Greek investors had only invested in Greek equities during their local debt crisis. To sum it up, be careful. Just because you're familiar with something doesn't mean that it's safer and more profitable.
Thank you, Leah. I have with me Valentin, an expert on market anomalies.
Hi, and thank you for having me. Market anomalies are price actions that contradict the expected behavior of the stock market. These often occur with no conclusive reasoning and can manifest once or on a continuous basis. The most known is the weekend effect, where prices close lower on Monday than on the previous Friday. However, they can even take superstitious beliefs, such as the aspirin indicator, where a decrease in aspirin sales indicates an increase in the stock prices. All in all, anomalies prove inefficiencies in the market and open arbitrage opportunities for traders and investors.
Thank you very much, Valentin. Now let's go to Fanny, an expert on technical analysis.
Technical analysis is a trading discipline which bases itself on interpreting statistical trends observed in trading activities. There are three main assumptions. The market discounts everything, meaning price reflects all fundamental factors, prices move in trends, and history tends to repeat itself. To take advantage of technical analysis and predict when to buy and sell, you need to find patterns in trading activities using tools including statistical indicators, moving averages, and support and resistance levels.
Thank you very much, Fanny. Now let's head to our expert on emerging markets, Thanos.
Emerging markets are in economies in the process of becoming more developed. They share common characteristics such as the liquidity in local debt, equity markets, and low income per capita. The classification varies among different organizations, such as the MSCI and S&P, with notable examples being Russia, Brazil, and China. These economies yield high return and bear diversification benefits from investors' portfolio. However, investors should consider volatility due to high risk from macro-environmental factors, such as an unstable socio-political environment.
Thank you, Thanos. In summary, behavioral economics looks at how human behavior affects financial decision-making. Behavioral finance looks at how psychological influences can affect market outcomes, and home bias is a bias where investors prefer to invest in their local markets. Anomalies show inefficiencies in the market, and technical analysis uses statistical tools to make informed decisions. Emerging markets are developing economies that provide high-risk opportunities for high yield. Thank you very much for tuning into the Financial News. We'll see you next week.